In the late September FOMC meeting, the Federal Reserve cut interest rates by 50 basis points, lowering the target range to 4.75 to 5%. This marked the first rate cut in 4 years and was aimed at supporting economic growth amid signs of a slowing inflation and moderate economic expansion. The decision reflected the Fed's dual mandate to promote maximum employment and price stability. Projections indicated a stable economic outlook with GDP growth around 2% and inflation gradually returning to long-term target. The move was seen as a proactive measure to sustain economic momentum. The key excerpt from the accompanying statement was that the committee gained greater confidence that inflation is moving sustainably towards 2%. At the time of recording, the Fed have held their November meeting and have opted to cut short-term rates by an additional 25 basis points. There's one FOMC meeting left for the year, which will happen on December 18th. It was a sideways move for the S&P 500 during October, closing out the month very close to where it started. Large and mid-cap stocks held up much better than small-cap stocks and added to the divergence of large versus small that we've seen throughout the year. Technology exhibited continued strength along with financial services. Overall, October was a month of mixed performance with notable volatility, but underlying economic indicators suggest potential stability moving forward. In overseas markets, the MSCI EAFE index, which tracks large and mid-cap stocks across 21 developed countries, experienced a decline of 5.4%. This drop was influenced by rising bond yields and mixed economic data. Emerging markets fared slightly better, but still were down 4.4% for the month. Turning to the bond market, the US 10-year Treasury spiked higher, creating a difficult backdrop for fixed income market. The spike in longer-term rates happened despite the Fed embarking on a short-term interest rate cutting cycle at the beginning of September. As rates moved higher, the Bloomberg Aggregate Bond Index fell by 2.5%, reflecting market adjustments to inflation data and future rate expectations. We've also reached a conclusion of the seemingly long presidential election race, and we look forward to discussing the market impact during our November market update.